This market punishes confidence before it rewards patience. Everybody wants to see prices go up all the time. Social media is a reflection of this. If you look at content here on YouTube, be it crypto or be it traditional finance, everybody recommends certain investments. Everybody says this asset will go up over time. But why are influencers bullish all the time? Are they all so delusional? Not necessarily. When we make a bearish video on something, that doesn't necessarily give a lot of clicks. That doesn't necessarily give a lot of traction. If we are bullish on something, then we are confirming the psychological bias of the viewer. Most people want to see their asset go up. And very often, the viewers of a particular video, say on silver, or on palladium, or on a particular altcoin, very often the viewers are not potential buyers, but are already investors of that asset. So if you talk bullish about a particular asset, you've got a higher likelihood as an influencer that you get a thumbs up. Being neutral or even being pessimistic does not pay on YouTube. It does not give reach. And thus, even though there might be some influencers that are somewhat objective, they don't necessarily grow as quickly as all of the very optimistic, very bullish investors. So there's the confirmation bias when watching the video, but even before that, there's a selection bias. So if you see some negative video, you might not even end up clicking on it. There's a filter here, right? We just want to get our views confirmed. That's what feels good, but it's not necessarily what makes money. And that's the big crux. That's why most people tend to lose money over time. They're not objective enough. They're not actively looking for what might invalidate a certain investment thesis. In the end, price is just the intersection of demand and supply. And if you want to predict prices, we just have to predict demand and supply. Let's have a look at Bitcoin. What drove Bitcoin's price in the early days? With the early days, I mean up until the end of 2017. Up until that point, it was really usage of the network. The number of active addresses on the Bitcoin network tended to grow. The number of transactions per day tended to grow. And it all grew up until the end of 2017, beginning of 2018. That's where we hit an all-time high in those metrics. That's when Bitcoin hit $20,000. Of course, Bitcoin at $20,000 was just an intermediate all-time high. We went down to 3.5K, but then subsequently we went up above 100K. So really, what drove the price from 2018 to today is very different to what drove the price up until 2018. There were always doubts around Bitcoin and crypto in general, right? It was created as an e-cash. But how was this e-cash used at the beginning? It was used for illicit activities, for Silk Road, to buy goods that were not available on eBay, to buy things that couldn't be bought outside of the dark web. But then, of course, Silk Road got shut down. That was in 2013. But there was still growth from 2013 until 2018. What was that growth? It was mainly speculation. It was just price appreciation, creating more attention, creating more price appreciation. We went from $200 at the market bottom after Mt. Gox and Silk Road collapsed up to $20,000. Right, a 100x in the span of roughly 2 years. And so the crypto industry really worked hard to legitimize itself, to say that we're not just dark money, we're not just speculation, we are something else. We have a real use case. Now, one such use case was to be e-cash outside of the dark web. So there was the creation of the Lightning Network to make Bitcoin more scalable, to make it usable for smaller transactions. But unfortunately, the adoption of the Lightning Network was also pretty much non-existent, even though there were quite heavy efforts. El Salvador even made Bitcoin a legal tender and tried to incentivize everybody to use Bitcoin in the country. That did not succeed. Then we had the introduction of smart contracts, bringing some kind of logic to money, creating decentralized applications, creating GameFi, right? So incentivized play to earn games, creating decentralized finance, so borrowing and lending outside of the banking system. So all kinds of use cases that did get an initial wave of adoption that then subsequently died down again. Because nobody wants to play games that aren't really that interesting, that simply just get some regular payments over time. And nobody wants to use decentralized finance when there are so many Ponzi schemes, when there are so many rebasement tokens, when simply just old investors get paid with money from new investors. And so really what happened with Bitcoin and crypto in general post 2018 was they got heavily financialized. The move from 20K to above 100K was all just financialization. There was no new adoption. There was simply just heavy investors getting into the asset. It was the Wall Streetification of crypto. So suddenly Bitcoin did not necessarily become a store of value to be completely independent of the governments. Suddenly we had ETFs. They were not self-custodied. Suddenly ETFs are of course also under the power of BlackRock and potentially as an extension under the influence of the US government. It also became more and more of a correlated asset to the rest of traditional finance. So when the Nasdaq 100 went down by 10%, Bitcoin went down by 20 or 25%. That correlation did not exist that much pre-2018. But post-2018, Bitcoin just became another risk-on asset. And so really what happened is that crypto expanded too quickly. Short-term thinking was incentivized. If you made a crypto scam, you were able to make millions of dollars and potentially get away with it. We see crypto scams until today, right? If you look at the comments below my videos, even though I try to remove the scams as quickly as I can, it's a cat and mouse game. It's pretty much impossible to get rid of them all. We also see this in the influencer space, right? Many people, they might not have just been bullish, but they might have gotten paid by various projects to promote those projects, and they might not have even shown this to their audience. We also saw this in the development of the meme coin market, right? So the market didn't even pretend anymore to build any utility. It was all just player versus player, all just 100% speculation. And so less and less effort was made to legitimize the space. The people that had a short-term time horizon, they all got rewarded. And that development is a shame because more than ever do we need some kind of capital that's not under surveillance of the government. Cash payments get more and more monitored. There are now limits to how much we can pay with cash. Once we reach the $10,000 mark, in some countries even just $1,000, we might have to declare this to the government. Bank transfers also get reported more and more often. The limit doesn't necessarily change, but there's monetary debasement. And so because of that, because more and more transactions over time get reported. And so what do we do in a system like this that's getting more and more levered, where the debt to GDP is very high, where capital concentration is very high, where there's a lot of efforts to take away the capital from the people that saved over time, that invested over time. People get debanked just by having different political opinions. People lose their purchasing power through inflation. People might not be able to move their capital, right? There's capital controls. There's taxation on wealth. We might get more property taxes. We might get more taxes on capital gains. To a degree, Bitcoin tried to cover that market, right? It was sold at one point as gold 2.0. The gold where we do know the supply, the gold that doesn't exist physically, but that can be transferred everywhere without any trace. The newer gold that's simply harder than the actual gold. But we have seen in the last year that gold was actually able to capture all of that risk. People that were scared of government overreach, people that were scared of inflation, they did not buy Bitcoin. They bought gold. And again, the reason for that is how Bitcoin is getting traded. The issue is that Bitcoin got more and more financialized. It got more and more leverage. It got more and more access by Wall Street. And because of that, it was traded more and more like a tech stock and not like a gold investment. And because of that, if tech stocks were to suddenly crash, then very likely Bitcoin would crash with it. Thus, Bitcoin is not a risk-off asset, a hedge. Bitcoin is just a levered bet on a continued credit expansion. And that's the problem. That's why Bitcoin isn't growing further. Crypto simply has too many risks right now, right? The risks of scams, of too much leverage, of too much volatility. We don't have that much risk in precious metals. And so can this change? How could this change? I believe we will see the change when the correlation between tech stocks and crypto breaks down. when the leverage gets flushed out of the system. When Bitcoin has sold off enough that all of the risk investors are out of the asset, then the correlation might break down, and then it might correlate instead of to stocks, it might correlate to gold again. Really, I want Bitcoin to compete with gold, not with risk on assets, because that's really the true nature of the asset right now. It's not cash, it's a store of value. It's a store of value of self-custody. We need to see more wallets holding at least one Bitcoin. We need to see that growth again. And ideally, we don't see that much more growth of the ETFs and of the treasury companies. Right now, they own roughly 10 to 11% of Bitcoin supply. I think that's enough. I don't want them to own 50 or 60% of the supply, because then Bitcoin really has no reason to exist anymore. Then all of the reasons it existed in the past as a means of payment or as a store of value, as something where it's superior to other asset classes, all of those positives will be wiped out. If Bitcoin drops enough, say by 70 or 80% from the all-time high, then the risk to reward ratio improves again, right? Then yes, we still have the volatility, but then we also have the potential upside, right? If we drop by 80%, then imagining another 5x return from that bottom isn't really that hard. It has done these kind of movements several times in the past. Once we have that 5x in Bitcoin, we then might even see again a rotation into the altcoins. And so then the cycle just repeats itself, right? We get a massive depression, everybody writes off Bitcoin, a few people buy at the bottom, things tend to revert, and then the market gets very greedy again, and a lot of people that get into the altcoins get wrecked. Some people make short-term money, those people get rewarded, those people become millionaires. The vast majority, of course, will lose again, and we will all complain again about the usefulness of crypto as a system. If as an industry we want to grow quicker than traditional finance over the cycles, and we don't just want to do this with credit expansion, but with actual usage, we have to find something. We have to find a narrative. So far, nobody is working on that narrative though. So we simply just ride the cycles, the same pattern as they've always occurred. That's at least how I approach the market right now. I'm rather opportunistic about it. I try to make as much money as possible, and I'm taking you along the way and share whatever I do. I share my individual trades, of course, in premium that pops up here on the screen. If it's the first time here, feel free to subscribe. I publish these regularly. Like would be very much appreciated as well. Helps the channel grow. Thanks for watching. See you next time on YouTube or see you in premium. Cheers.